I now request Mr. Nirav Shah, Group Head Corporate Banking, to come and present about the corporate cluster.
Okay, just to set the context to the presentation, go to the next slide, please. So, corporate bank deals with the topmost companies of the country. We deal with large conglomerates, the likes of the MDA Group, Birlas, Tatas, the Murugappas. We deal with large public sector undertakings, NTPCs, Power Grid, GAIL of the world. We deal with large multinational companies, likes of the Levers and the Siemens of the world. Our efforts are recognized by Asia Money in terms of being recognized as the best domestic corporate bank. In terms of, just to set the context in terms of what we contribute, if we look at Indian banking system, the total credit book of the banking system is 136 lakh crores. As per the last March end data that has been published by RBI, the large corporate space is 38 lakh crores. While there would be other departments of the bank who will have assets in this particular space, corporate bank today on the loans and advances side is a little over 4 lakh crores. So we have a 10.5% share of the business. There is a runway. As we see, the pie is very large, and that is what keeps us excited. So on one side, you will have growth opportunities that the economy will throw. On the other side, there is still a runway in terms of consolidating our position with existing clients and bring in more new to bank customers. Asset is only one part of the business. What do we really work towards is leveraging assets to gain volume share. So if we look at it in terms of cash management, we have seen over the last 2 years a CAGR of 36%. In terms of exports, we have seen our volumes go up by 79% in 2 years, and in terms of imports by 87%. If we look at it from the point of view in terms of what is our wallet share, cash management today will be somewhere around 35% with customers that we are engaged with. Exports will have a share of 20%, imports will have a share of 18%. Idea is how do you leverage your relationship and build on to volumes, and we'll cover in terms of the benefit of these volumes later in the slides. Yep. So how do we touch a corporate? Let's imagine a corporate puts out a project, needs money, we are there with term facilities. For working capital requires assistance, we are there. Once the plant is operational, there would be domestic sales and international trade, we are there with solutions. We do cash management, collections, payments, we facilitate international trade, fund it. We integrate the entire supply chain and provide solutions around it. Company makes profit, they need to pay taxes, we are there. There are employees and we handle their salary payrolls, and at the end of it, at the end of the year, whatever profits they distribute to the shareholder, we end up handling dividend. So we touch corporate across all their financial requirements. Greenwich, which is a subsidiary of CRISIL, they come up with their annual survey. Ours is a relationship business, and what makes us really proud is in terms of recognition of excellence when it comes to customer advice, digital experience in terms of dealing with us, and customer service. A lot of it ends up creating stickiness and ends up, everything else being equal, we get the first right of refusal with our clients. In terms of market penetration, we are number 2 after State Bank of India. Clearly they have had a vintage of more years, and we are very quickly catching up with them in terms of dealing with more companies in a meaningful manner. So what did we do? There was this question, large corporate credit grew at 3%. Balance sheets were deleveraged, capex cycle was muted, profits got deployed in terms of bringing down working capital utilization. Even during this particular time when large corporates witnessed a 3% credit growth, last year we've grown at 12%. We've let go of assets of more than 1 lakh crore in last financial year, and all of these names we had credit appetite. but we were selective. We said whatever makes commercial sense to us, we participate, otherwise we let it go. In spite of that, we've grown 4x than the market. The investment book, we read the signal in terms of the rate cycle and said it is best that we avoid putting on more investments, and that's where we've been conscious of running down some of the investments that were held by the corporate bank. The exposure is fairly well distributed across multiple industries. Just want to pick up on a couple of them. If we look at NBFCs, we have a substantial share here. But if we look at in terms of exposure, 98% of our exposure to NBFCs is to AA and AAA rated entities. In fact, 61% of the exposure is to AAA rated entities. 50% of this particular exposure is actually to Government of India promoted NBFCs and financial institutions. If we look at it, this is a source that helps corporate bank generate priority sector assets, either in the form of on-lending or through PTC partnerships. The second large exposure is to the electricity and power sector. Here again, 71% of the exposure is to Government of India owned entities, the likes of the NTPCs and the power grids of the world, where we have substantial relationships. So just to touch base on the book dynamic, the quality of the book has remained pristine. At a book level, we will be somewhere between a AA to AA plus. And since last time I presented to you all, there has been a further improvement in terms of the book. In fact, the incremental credit cost last year on the corporate book was negative. So this is the quality of the book that has been built. In terms of the book, we are fairly well balanced. And I'm talking of terminal maturities. And as a thought process, we only fund with amortizing schedule. But even after looking at terminal maturities, if we look at it, 21% of the book has maturities of less than 1 year. 37% of the book is between 1 to 5 years, and 42% of the book is more than 5 years. Again, there is a science where when we look at exposures beyond 5 years, you will see that large part of it is to better rated clients. And as the rating drops, the tenor of the book reduces. So it's a well-structured exposure strategy that we follow. In terms of the actual book, we have 89% of the book is floating. And while rates were going up, in the last 1 year, we saw an increase of 191 basis points in the book yield. And that is where we don't run any interest rate risk in the book. Portfolio is linked to MCLRs, repos and T-bills. So anywhere between 1 month to 1 year, the rates keep resetting based on the benchmark change. So if we look at it, what do we aspire for? We want to create a corporate bank that is not only supporting customers through balance sheet, but through several other services. So when we look at international trade, we've seen Trade on Net is our platform which customers use to engage with the bank. While trade in the country did not grow at the same level, we ended up seeing a total growth in trade by 16%. And through the digital offering, we saw an increase of 21%. In fact, 90% of transactions with the bank today on the international trade side are processed through the TON system, untouched by human hand. What is the value proposition we bring to the table? If you have imports and you need IDPMS reconciliation, it is done online. EDPMS, we do it online. And this is the value that we bring to the client, and that is where these volumes move to us. In terms of the LCA business, we primarily look at cross-border trade for letters of credit, which makes itself available for offering foreign exchange solutions. When it comes to bank guarantee, we prefer doing domestic guarantees where the risk is substantially lower. In terms of the supply chain part of it, very well balanced between domestic supply chain and international supply chain, and we will see both of these aspects growing as we move forward. Collections and payments, we've seen a 25% growth in collection volumes, 22% in value terms. If we see, we are well diversified across industries. Each industry has a unique requirement in terms of collection solutions. And if we look at it, we have solutions across all industries. Statutory payments, we've ended up seeing a growth of 40% in the total tax that we have collected over last year. And country's tax collection hasn't grown to this particular extent. So we continue to garner larger and larger share of the tax throughput. Now, if we look at the corporate space, and there was a question around the corporate liabilities, yes, it is transitory in nature. But if we look at it, corporates have a fixed date for their payments. That is, they know exactly when the vendor payments would be done. The TDS and the advance tax dates are known. Salary payment date is fixed, but their collections come throughout the month. So in fact, what you end up collecting ends up staying in the account, and that is where we end up getting floats. So more the transactions that you handle, higher likelihood of you getting the float. Now when you look at taxes, somebody does not fund the account only on the day the tax has to be paid. So at times when it comes to e-freight or customs duty, you don't know when the account will have to be debited. So in anticipation, the account remains funded. And we try and capture these flows to ensure that we grow the liability book. One of the things which is pivotal to our growth strategy is continuing to get new to bank. Last year I had shown this particular slide wherein I had said that there are 617 names that we are pursuing at this point in time, and happy to share that in last financial year we have converted 208 of those names and have a good visibility in terms of conversion as we go into 23-24 as well. So what is one important thing is in terms of the corporate employees, and these are great quality accounts that we source for the bank, which makes itself available for various cross-sell opportunities. So today if we look at the salary book, 43% of the savings account balance in the salary book of the salary portfolio of the bank comes from corporate bank clients. In terms of salary credit upload every month, 46% is to corporate bank clients. Of the new accounts sourced, 20% of the accounts are sourced from corporate banking customers. In terms of the total salary accounts at 25%, and there is at this point in time 60% of our corporates have their salary engagements with us. And the idea is to keep taking it closer to 100%, and that's an area of focus for us. And we have seen in terms of balances in these accounts being almost 1.2 times as what it used to be before. So mentioned about leveraging the asset relationship. If we look at it, our customers, we have a 28% share of the FD wallet. We handle 35% of cash management, 20% exports, 18% imports, 30% of taxes, and 35% of dividend distribution. So we have a disproportionate share of other businesses. And what does this particular share of the ecosystem does for us? So if you look at the revenue mix for corporate bank, only 57% of the revenue actually comes from asset, and 43% of the revenue comes from liabilities, fees, and cross-sell that we do. And we have identified avenues wherein we will see growth across all the 4 revenue lines that we operate in. One of the things that last year we had mentioned was in terms of ensuring that we improve return on capital. At this particular point in time, if we look at it, high capital consuming accounts with very low return, we have improved from a 7% to 6%. In fact, we have seen reduction across the three categories wherein high capital, low return, low capital, low return, low capital and increase in low capital, high return. So across the board, there has been an improvement across all the four quartiles. While we do this over the last 3 years, it's a very, very small team that we run. We have a team of 108 relationship managers that manage this book. But if we look at it, what does this team deliver? This particular team, while the team has grown over last 3 years by 28%, we have seen an increase of a little over 60% in business per RM and profit contribution per RM going up by 58%. So effectively, this is where we bring in productivity. It is the lowest cost to income business, virtually zilch credit cost, and that's where the contribution from the business is high. So while that was financial year 23, how do we see the business landscape and what is it that we are looking at doing? At this particular point in time, most corporate balance sheets have been deleveraged. Capacity utilization is somewhere around the 76%, and while we expect capex cycle to be muted for the next few months, but there is balance sheets are capable of taking large value capex, which is where we can participate. Financial year 22-23 saw wide fluctuations in commodity prices, whether crude, metal, you look at freight rates, everything fluctuated. The good part is at this particular point in time, prices are trending lower than what corporates have budgeted. Two, high cost inventories are out of the book, and therefore we will see stable operating margins continuing. So there is better visibility on profitability that gives us more confidence in terms of extending credit support. We saw interest rates go up, but did that create any stress in the corporate world? Answer is no. The debt service metrics continue to remain buoyant. Companies are looking at engaging through digital platforms with clients, with the bank and their supply chain counterparts. We've been working on this. Today, we are a significant player in the collections and payment space, and 95% of transactions are processed straight through. This is creating stickiness plus a model to handle transactions at low cost. In terms of the opportunity space, PLI, asset monetization, initiatives around green energy would provide further capex opportunities for the corporate bank. So what are the key growth drivers that we are going to work on? Imagine in the corporate bank business, the delta in terms of the income has to come from a combination of three things. Existing customers, existing products, you need to make more money. Existing customers, new products you need to bring in, and bring in new to bank clients. Typically, we would, a thumb rule that we would follow is 1/3, 1/3, 1/3. And this creates a sustainable corporate bank which will grow without having to compromise on the basic principles. And our experience is when you keep bringing in those new to bank clients, typically you see second year revenues doubling as product engagements grow and you end up getting a higher wallet share. Liability is an interesting piece. While I touch base on a few parts, each company works differently. Some of them believe that it is better to have your pooling account with the collection bank. Some of them prefer it is better to have it with the payment bank. Some of them invest into mutual funds. Each customer is unique, and that is where a solution-based approach, a relationship-based approach, and backed by strong product offering helps us to structure individual solutions for each client. We spoke about the book yield going up. We'll continue to be selective in terms of asset. We do believe that we've seen rates correcting. What does not make sense, we will not participate. What makes sense, we are not in the business of purely extending assets. We want it to be a meaningful relationship, and that principle stays. One initiative that we've embarked on is creating 3 separate business verticals. One catering to large corporate coverage, second catering to public sector undertakings, and third when it comes to multinational business. Across these verticals, the decision making is different, the industries they work in is very different, in terms of the key product engagements are very different, the delivery channels that are being used are different, and strategies will have to be different. So we've tried to ensure that how are we engaging better with each segment, so that in terms of the non-asset part of the business, we continue to gain market share. PLI, I'm sure all of you all have been following what is happening in the sector. 15 sectors, 4,64,000 crores of capex, 510 approved applications at this particular point in time. We are engaged with 177 of them. 101 of these clients we have visibility. And it is not only about asset. A lot of PLI investment is going to come in the form of FDI. While all of you all would have seen this morning in the newspapers that the FDI numbers dropped. But we are hopeful next year there will be a pickup based on our engagement we have with clients and the visibility some of them have provided. 2, it's not only about asset, it is about having supporting the EPC contractors, it is about incremental salary accounts, it is about facilitating trade, and there are multiple opportunities that the PLI will open up for the banking sector, and we are looking at continuing to gain a share out of it. Supply chain is a good product engagement. We have seen very good traction with our clients. 80% of transactions today on this platform are digital. We are live now across all the 3 threads platform. In fact, we are looking at further improving this particular business through certain fintech partnerships, which would allow us to offer dynamic discounting, deep tier funding, which would be first of its kind in the market. While it is a relationship business, there is a digital transformation that has been in the works. The way we are looking at it is, 1, being cloud native for sure. 2 is how are we going to improve employee experience and improve the sales capability using artificial intelligence and machine learning capabilities. On the other side, how are we streamlining customer experience on dealing with the bank? Some of the initiatives that we would be running, one is in terms of upsell and cross-sell opportunities that would come out of analytics from the customer's transaction behavior. In terms of providing one view to the relationship manager and giving pointers and getting the relationship manager better prepared for having better narrative and conversations relevant to customers' business. Pricing intelligence engine is another great initiative in terms of, based on the profile of clients and across the portfolio, how are assets being priced, and for a similar profile of client, what is the recommended price or what is the fair price that we should be getting. So how do we ensure that we are not selling ourselves cheap. On the customer side, customer requirements are changing. We continue to have a very large share of transaction banking, but how do we provide value-added services? Can we do something on the account reconciliation side? Customers would have a habit of clubbing 2 invoices and giving one payment. Can we help reconcile those kind of consolidations? How do we integrate it with the ERP system? So there is a lot that will keep happening to ensure that we maintain our leadership business across products and continue to have our engagement deepen with clients. So finally, What is it that you should expect out of us? Increase in product holding with existing clients. We will continue to bring in new clients. We will participate in opportunities that the economy provides. We will see a substantial increase in our supply chain engagements. There are a few new product offerings that we will come up with. Aspiration is to become the preferred bank to multinational companies working out of India. All of this through digital offering and fintech partnerships. And that is where we will create a profitable and sustainable corporate bank. Thank you. If there are any questions, happy to take them.
Hello. Yeah, hi, Neeraj here. Three questions. One is that what is the size of the credit substitute book that we have? Number one. Number two is that what is the RAROC threshold that we have that we work with? One is the new clients, and then obviously there are a lot of clients which basically over a period of time mature, and then you would take a call that basically whether you want to continue with those clients or basically you want to go up there. And third is that you talked about the corporate salary account, but what is the current account contribution which comes from the large corporate banking relationship?
Okay. So in terms of, first question, credit substitute, if you can just repeat the question.
So what is the size of the credit substitute book that we have?
Very small. If you consider the investment book as credit substitute, then 60,000 crores out of the 4,60,000 crores that we would have outstanding.
Is there a scope basically that this book can go up?
There is scope, but we need to decide if we want to grow that part of the book or not. Combination of factors. There are opportunities across both credit substitutes and on balance sheet loans. We will figure out where commercially we can make more sense, where customers want to engage. So over a period of time, what we saw in terms of the data is, anyways, the debt market portion was coming off. Over the last 1 month, we have again seen a preference towards going. But if we look at interest rate cycle, debentures were a fixed rate instrument. And today, when you look at an OIS curve or something, today expectations are that India will start seeing a reversal on the rate cycle. So preference again may be to move towards bank loans, which are floating in nature rather than engage on a fixed rate instrument. But we look at the developments in the market and decide we are open to opportunities across both parts of the business, and we'll participate where it makes commercial sense. Second question you asked in terms of the
RAROC threshold.
RAROC threshold. So we don't work with a threshold, we work with a direction. So initially when you acquire a client, your RAROC will always be lower. But do we have a visibility in terms of how are we going to improve RAROC? And that's the approach. And corporate banking is not a short-term thing, it is a long-term business. So by the time you engage, it takes almost a year to convert a new to bank client. After that, as you penetrate products and then end up getting your wallet share, it may take anywhere from 2 to 3 years. We would not acquire anything where we do not see a visibility in terms of improved earnings. But otherwise, there are regular reviews that happen in terms of customers with low returns, and that's a very small percentage of the book. And we do see a visibility how we can convert all of it. In some cases, it can be in terms of getting facilities weighted and bringing down the capital consumption. In certain cases, it may be to do with bringing in cross-sell. It can be to do with pricing the facilities right. There can be a penetration pricing to begin with, but as relationship matures, you get your fair price on the asset. So a combination of things, and idea is that everyone should be generating fair returns for the risk that we take. The third one was on salary.
About the current deposits, what's the large corporate banking contribution to the current deposits?
I don't have that particular percentage with me. Probably FinCon will be in a better position to provide that particular answer.
Thank you.
The question is referring to, the floating rate loans, the proportion, around 90% of the, loans are on floating rate. And especially some portion on repo and T-bill. So if you can disclose what is the proportion on repo and T-bill of the corporate loans that we have?
So I don't have while I have 89% of the loans linked to MCLR, repo and T-bill, the exact breakup between the three benchmarks I may not have. Financial control may be in a position to share it with you separately. So.
Okay. So related question, that, T-bill rate, if you see the short-term T-bill rate has already fallen by around 29 bips from March end to now, approximately around 7% number. So has the repricing of the loan linked has been done, or it will be done after a year? So how the repricing will happen?
Okay, so the repricing frequency varies for each benchmark. So for example, when it comes to T-bill or repo, the repricing has to happen once in a quarter. Any external benchmark used as per RBI guidelines need to be repriced every quarter. MCLR can be anywhere between 1 month, 3 months, 6 months or a year. So depending on the reset date, you will see the benchmark reset happening. To react to the point in terms of the T-bill having cooled off from March end, but if you see from beginning of March or middle of March to end of March, we ended up seeing a surge of almost 30 odd basis points in terms of the T-bill rate. And since March end, we have seen some cool off. So today rates are more or less in line with early March 23 period. Rates will be volatile, but we don't run any kind of an interest rate risk because it would be matched in the ALM accordingly.
See, the March ending, result is already over. So we are now looking at June ending numbers. So basically, this portion of the book which is on the repo and T-bill certainly will generate, lower, spread, because your TD rates would keep going up, and this repo and T-bill, linked loans, after a quarter, rates should get, repriced, as you said just now.
So we don't, business does not run any interest rate risk. So as we pay a premium when we borrow funds from the central finance utility for not running the interest rate risk. So margins in our book will be same, and it is for treasury otherwise to manage the interest rate risk. But businesses don't run interest rate risk at HDFC Bank.
Just one more question on the MCLR, because we saw that there is a, change in the tenor premium, when we, reduce the rate. So are we going to use this tenor premium into the MCLR, or?
Sorry, I'm not the right person to answer that question. Probably the financial control and treasury would be able to throw better light on it.
Sure, sir. Thank you. Thank you, sir. Thank you.
So, Adarsh from CLSA had a question now. This book used to provide some duration to the loan book, right, for HDFC. Now you've got mortgages, and there is some pressure on the bank needs to raise more resources as well. So just trying to understand how does it change the outlook on the balance sheet size for the corporate bank? And a related point is if you go a little slow on lending because of resources, or you have other products which offer duration, then how does your fee intensity change, the engagement levels change?
Okay. So in terms of the tenor, let me just take the first question first. If we look at the incremental booking over the last 12 months and we measure it at a quarterly intervals, anywhere between 65% to 75% of the incremental loan booking has come in shorter tenor. Now, we consciously don't chase a particular tenor or a particular thing. We look at transactions which make commercial sense to us. So, is there, with the mortgage book coming, would we start going shorter on the corporate bank? Answer is no. Whatever are the opportunities that come to us, we'll evaluate and decide what makes sense. But over the last 1 year, we have seen anyways an increase in the short-term incremental bookings, more particularly coming out of the fact that the capex cycle was muted, and with commodity prices going up, investment in working capital went up. So that's where that particular book composition would come in. Your second question was on.
Second question I asked is, let's say there is constraints on deposits because you merge, right, over a period for the next short term. I'm just trying to understand, if you don't go credit on corporate, does that change the fee intensity or engagement?
Not really. See, there are today customers want to engage. Everything else being equal, they would want to engage with someone who can extend a larger balance sheet. And today we are the second largest bank. Part 2 is there is a RBI current account circular which talks about in terms of a minimum share of 10% for you to handle transaction banking. Part 3 is customers today are looking at solutions and not products. Today someone can extend balance sheet but cannot integrate with the ERP system of the clients, cannot go paperless, cannot reduce cost. In that case, they are not going to, just because you've extended a balance sheet, you are not going to take a suboptimal solution on transaction banking. So idea is that if you keep improving on your offering to the customers, keep delivering in a digital platform, keep cutting edge products, customers will engage with you subject to you having 10%. So it is not about large exposure or small exposure. You have to be at the threshold of 10% or higher and back it up with great product supported by efficient customer service.
Got it, thanks.
Hi, morning, Manish this side from
Hi.
Axis. You talked about letting go of business because of competitive intensity. All the signs indicate that given the lower NPAs in the system, that intensity may not abate anytime soon. So as a strategy in terms of going forward, if intensity goes up further in large corporate space from public sector banks, do you still continue to forgo business, or at some stage you start accepting a lower level of profitability?
So there is enough and more opportunity, Manish, in the market at this point in time, and I don't see a reason why we cannot continue to be selective. Second thing is where we've seen competition, and for every transaction, we have it mapped in terms of which bank took it at what particular price they took it, what tenor they took. I can cut the data and I exactly know which particular bank is following which particular strategy, who is looking at public sector versus large corporates, who is looking at term, who is looking at short term, who has what kind of rate thresholds. I know everything what competition is doing, and some of these strategies I don't see would play out in the long run. So on one side, when opportunities were minimal, you ended up seeing people do irrational pricing. You ended up seeing people engage purely on an asset play model. But as opportunities, the scope widens and the liquidity dries up even for some of those banks, they will have to start looking at it. And progressively, as we see it over the quarter, even those banks have started inching up their benchmarks. They would see where competition is pricing it, and then they also start realizing that they ended up selling it a lot cheaper than what they should have done. So we've seen in terms of gradual move, and it may take 3 months, 6 months, 1 year, but the opportunity space is large enough, and you cannot expect every bank to be there for every transaction. So you will find your viable transactions.
Sure, thanks.
Yeah, hi sir. This is so.
Two last questions.
So sir, you mentioned that around 89. So here, so 89% of the book is floating, right, in the corporate space. So I wanted to check: is there a effective difference for the bank in terms of yield if a corporate is on MCLR versus the same set of, let's say, quality corporate is on repo rate or T-bill linked, right? As interest rate move forward, is there a mechanism wherein the effective, let's say, the rate to that customer automatically adjusts irrespective of the lending regime he is in? So over the last 12 months, maybe there would be few months of gap between, you know, a customer is on MCLR versus EBLR. But does it really meaningfully different, or this is more cosmetic versus when it comes to banks in terms of effective yield?
Okay, so I think it is, there can be a lag effect. So you may see T-bills going up faster than the repo. You will see probably MCLR change even slower. But so there can, directionally everything moves. Over a period of time you will see rates converge at a particular level. But there can be a lag in terms of going up, there can be a lag when it comes down. But directionally things would end up converging over a period of time and over a short period of time itself.
No, so let's say, sir, if a corporate is on MCLR and let's say March was his reset date, would the lending spread will automatically change as per your MCLR? It would be reset based on market
so the
rate
way it works, and this is how the RBI guidelines make it happen. Your spread over the benchmark is fixed. Only the benchmark changes. So for example, if someone is on MCLR and we did a reset in September 22, and at that point in time the MCLR was 875 and we had a spread of 50 basis points. In September we did that particular loan at 925. Now the loan then becomes eligible for reprice in September 23. At that point in time, if MCLR has gone up to 905, the rate becomes 955. So on the anniversary date of reset, the fixed agreed spread over the benchmark gets applied, and that becomes the effective rate going forward.
Sure. And secondly, the new to bank revenue that you shared, right? That looks a bit higher because, you know, you said 30 to 32% of the revenue is contributed.
Incremental revenue.
Okay, sure.
So if it is 100 and it was to go up to say 115, out of the 15, 1/3 through new to bank, 1/3 through existing clients, existing products, and 1/3 through existing client, new products.
Thank you, sir.
Thanks, Nirav. Just two quick questions. The first one is, you mentioned that, and even Kaizad earlier, that you let go of about lakh crore kind of a business last year. Can you elaborate what were the reasons? Because typically at times, even if you have to compromise on rates, you make money elsewhere, which you rightly alluded or talked about in your presentations. That's one. And two, just big picture PLI, how realistic do you think that would be from the capex standpoint, and when do you start seeing the meaningful difference in our numbers?
Just put the PLI
Thanks.
slide. So out of the 1 lakh crore, it's a combination of several factors. So one is we may find the absolute rate at which some of the banks quoting not remunerative. There are times when we know that the corporate has very large borrowing plans, and it is better to wait out, and next month or next quarter you will end up getting better price. See, it is not a race. You don't want to be in the race to be the first to disburse, but you want to disburse at the best possible rate. The third factor can be that you may have the credit appetite, but you may want certain covenants which the customer may not be wanting to provide to you, and someone is ready to take a covenant-less loan. Fourth thing is that the rate may be good, you are ready to participate, but you don't have a visibility in terms of cross-sell. Now, if I was to just be a loan provider to a client, and client does not give me visibility in terms of the other businesses, in that case, what is the value that I am providing to the client? We are in it for leveraging our asset volumes to generate value proposition for the client and for the bank. At this particular point in time, I would say we have a fair visibility in terms of the pipeline. But if a scenario was to come, I don't see ourselves doing anything just for the sake of growth. We let go of business. There can be a lower growth. Thankfully, the bank has all asset engines firing. So the growth may come from somewhere else, but we don't have to compromise on the core principle over the years that we've lived by and built the corporate bank. Yeah, so this was in terms of the PLI that you asked. So if you look at it, the total capex, and this is certain clients are undecided, but amongst the customers who have freezed on their plans, 75,000 crores is likely to be spent in FY24. 104,000 crores is going to be spent in FY25. And the PLI scheme, the way it works is they have a 5-year window to end up spending the entire amount. But we see substantial amounts getting spent over the current year and the next year. This is what the customers have shown us in terms of the project reports, in terms of the drawdown schedules, and we've borrowed from the plans that we have with us. Yep. Thank you.